Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and odds are that you're watching this video because you got an email from me telling you that it's up. Now, we'll talk about the stock market in a few moments, but uh, if you haven't done so yet, you need to subscribe to my free email list. You'll see a link to do so right below this video. Then you'll find out the next time I put a video up. Now, I'm going to try something new. This past weekend, I wanted to try something where I could create, uh, in an easy way for me, a public model portfolio and share with you, use it to share with you how I'm navigating these markets. Because we're in a tough market environment this year. You've seen stock market volatility increase. The stock market averages are down. The ARK ETF has just gone down the toilet. And so have so many of the fad popular stocks, and I've talked about that in the previous videos. But at the same time, once this turmoil in the markets is over with, there's going to be a tremendous opportunity to buy stocks. And there's still a good opportunity to make money by buying and investing in things that are outperforming the stock market averages. You see, the key to long-term success as an investor or trader is to simply trade and be in those things outperforming the S&P 500. That's why I have zero interest in trying to guess the bottoms in stocks that are just in vicious bear markets, such as Robinhood, HOOD to name one, or ETFs or sectors doing the same thing, such as the ARK ETF. How many people have tried to predict bottoms in that and have failed? And when you fail, you lose. And if you catch it right, even in a bear market, you still aren't going to make much. It's a very difficult environment to do that. But if you buy dips in energy stocks, if you buy dips in gold, commodities, much different story. But all that said, I just was thinking about, I want to do something that, is something unique that other people aren't doing, and it can help you understand more how I'm really navigating these markets. Because picks, buys isn't the most important thing when it comes to investing and trading success. The most important thing is how you're managing your money, how you're allocated in a mix of asset classes or funds and so forth, and how you make adjustments. And by creating a portfolio that pretty much mimics what I'm doing in my retirement account and my main larger portfolio is a good way to do that with you. All that said, well, I tried something like this in the past by using the Robinhood app. I opened up an account there 4 years ago, I think it was, but it's just doesn't have enough information on it. And I don't want to encourage people to even open up an account on there. I thought at the time it was something good. It was bringing new traders into the market. But through my usage of the app and to seeing, how it's, even since in the past 4 years, it's only done more and more to encourage people to get into bad trades, to take bad positions. You open up app, and I just, I've said this in the past. So I wanted something different, something that would also be easy for me to use and share with you. So what I did is I went and I took a look at all the top most used apps now and found one that looks like it's going to do what I want to do. It's called TipRanks. And I opened up an account over this weekend just to get started. So let me share my screen. And below this video, there's a link so you can see this. So, okay, I have created a public portfolio on TipRanks. And you may want to open up an account. You can do this same thing yourself. But anyway, if you click the link, it'll go to this page. Now, I just started, so there's not much information here yet. The idea is I want to make a track record too as part of this process. And what's interesting is they have a list, we'll look at it later in another video, of experts and hedge funds and analysts. So you can rank yourself with these other people. It's sort of like a competition. And that's something I want to do. I want to see if I can do well against other people this year, not just talk about it, but show it with you. And in that, if you can see me be successful, that will encourage you to be successful too. But anyway, I started this over the weekend, and this, my goal is to get this so it's 50% invested in ETFs, and then the rest will be in individual stocks. Right now, there's not any individual stocks in it. As I said, I'm just starting, and because of the way, we'll just flip to it, the stock market is at this moment, quite frankly, today, May the 3rd, much less, yesterday, May the 2nd, I just don't see a great trade to make at this moment in anything. And my, brokerage account, my retirement account, I'm already positioned. I've got lots of positions already. But this is a bit of a challenge to start a brand new account at zero when you're in a market where there just ain't great trades I don't think, to be had at the moment. So even though I think we're in a bear market and ultimately the stock market's going to go lower, we could see more of a bounce this week. And I don't, so what I'm really trying to do is get this going. So when I see a good entry point in something, I can, start doing stuff in this. But to start this up, I had to take some positions. So here's how this portfolio is actually positioned right now. And this is the percentages. I got it all in ETFs. That will eventually change. But I start out all ETFs. So I got gold, 14% is approximately in gold. My retirement account is positioned exactly like that too. A core allocation, 14% in gold. And also with the DBA ETF, 14% in my IRA, my main account too. Now I bought those positions well over a year ago. So, this is not a recommendation for you to go out and buy gold right this second. Although I'm bullish on gold, these aren't trading recommendations to make right at the second. I'm just getting this going. And I also got 2 short ETFs, RWM and PSQ. Because what I wanted to do was be 50-50, long, short, and have this model portfolio hedged until I start to see something good, to buy, or I think there's a better short entry point in the stock market or a sector than we see right now. I just don't see great trades to be made at the second, but I got to get this going with some sort of positions to begin a track record. So I've basically created this account. So I'm trying to make it so it won't have a big swing one way or the other. And that's why 40%, almost 37.42%, is in a short-term treasury bond ETF, SGOV. This ETF barely moves. It's only 3-month treasury bonds. So I'm just like parking it in here basically as something to put it in instead of cash. So that's how I'm starting. You can click the link anytime you want to see what happens. And I expect at some point, I'll start to make some trades in here. It could be in a week. I don't expect to be doing anything this week, but who knows what happens. If there's something surprising that happens to me after the Fed meeting, and I think there's a low made in commodities, I'll buy them. But I don't know if much will happen. We'll just see what happens, but I just want to tell you in this video what I'm doing. I got this started, and I'm hoping this website will work for what I want to do. Again, the link is before it. I opened up an account for free. They have some payment options that don't cost that much. Kind of want to try it for a few weeks, and if I like it, I'm going to go to one of the pay things myself. And you can do this and track many people and get alerts when they do a trade. In fact, who knows how this will evolve? Maybe it'll end up other people will be doing this with me, and we could be sharing information together, getting the alerts together. And of course, I will talk about on my website or in videos the rationale I make for the trades I do with this account. That's really what it's the whole point of it too for me. So again, to turn to the stock market again, and why I'm just trying to be as neutral as I can opening this. I just don't see a great trade here. I mean, the stock market, just looking at the S&P 500 here, it made a new 52-week low Monday after dumping Friday. And yes, I know people are trying to buy the bottom. There's people saying there's bearish sentiment. I wrote an article why I think the bearish sentiment means absolutely nothing. In the 2007 bear market, there are more bears than bulls in the Investors Intelligence Survey by the end of that year. And people were thinking that was a good reason to buy. Well, the bear market continued for another 15 months, so that survey was 15 months early. That's not a reason to be buying. I think we're in a market that's in a slow motion bear market that's just starting. But I do think there's opportunity in other things. So for example, this tracks the Commodity Research Bureau index. It's just consolidating, and we had a huge run in commodities in the first quarter. Obviously, everyone knows that. And now they're consolidating. They're going sideways. And I think they're likely to go sideways for a couple months and then have another run. The price of oil is very similar. We're at 105. For all these people trying to call the top in oil, all it's doing is trading above $100 a barrel. And that looks to me like something that's going to be in a range and could go up again. Energy stocks, though, they still are looking good. I own energy stocks. I own XLE in my IRA. I did not put that though as a position here because I just want to get this going. I think there's going to be a better entry point for energy stocks, and I might buy individual stocks instead of the ETF. But there's an interesting appearance today by Paul Tudor Jones on CNBC. I'll link to that too in the notes for this video. But he was on CNBC and he said he can't think of a worse financial environment now for stocks or bonds. They asked him, "What do you buy now?" And that was his response to that question. He sees a big problem with everything is inflation is forcing the Fed to raise rates, and it's going to impact all the financial markets. But inflation is what's driven the bond market into a horrible bear market. And I've said this before, the most important single thing happening in the financial markets is the simple fact that interest rates and yields on bonds made a secular bottom in 2020. And we're now in a secular bear market in the bond market. And hence, he can't see a worse financial environment for stocks or bonds. Well, bond bear markets are a net negative for most stocks, not all stocks, not all sectors, but for most. And they hurt the most highly valued speculative stocks and assets the most. So it's a difficult environment. This moment right now in the financial markets is very challenging because it brings big volatility in short-term moves that don't really amount to much and lots of fake out moves. Okay, we broke down Monday, but we bounced. But is this bounce? So you could say the Monday breakdown was a fake out, but here we're up. Is this going to lead to anything? I really don't think so. We got the markets below the 250-day move, 150 and 50-day moving averages. I don't really think this rally is going to amount to much. I'd be surprised if it lasts by for the entire week. I wouldn't be shocked if the market doesn't start falling, if not after the Fed meeting by the close Wednesday, then on Thursday. But regardless, we now have resistance at that 50-day moving average. And we were just there 2 weeks ago. So that's how negative this market is. It's going to, if this was really a bottom, we would have a bottoming process where we'd rally, bounce up to 4,300 and come back down to where we are now, chop around. You saw that like in February, March, and then a short-lived rally that went to nowhere. So very, very difficult situation. So I'm hoping that by talking about a public portfolio and allocations, that it'll help you navigate this type of market situation and position yourself, both of us, to take advantage of fat pitches in the market when they come. Like right now, I think trading and investing, taking positions at this moment, is like swinging at curveballs. If you think about a baseball batting analogy, when you want to lay off the curveball and wait for the fat pitch. But in the market, you got to be patient and disciplined and have a strategy to do that, because it's so easy to be tempted into doing something. And every single time you turn on CNBC or look at Twitter, there is an expert telling you to do something, promising you'll make money. It was just, what was the stock? There's TDOC crashed last week. A total collapse in this stock that had been in a vicious bear market, underperforming the stock market averages. And what happened? Kathy Wood got on CNBC and said, buy this, it's the next Amazon and you're going to make all this money. Well, how is this the next Amazon? I don't see it. I don't see how Teladoc is going to become as big of a company or opportunity for people buying now as Amazon was for people. So, but this sort of hype is what fuels the financial media. It's what people want to hear. So it's also a question, is videos like I plan on doing or talking about investing like this, is it even going to catch on? Will people even care to listen to it? I don't know. That's something we'll see together too. We'll see what happens. But if you like it, hit the like button. That way YouTube will know, to share this video with other people. Because if no one likes it, they won't share it. If people just tune out, then YouTube sees that, their algorithm kicks in, doesn't show these videos and shows the hype videos that people want. YouTube gives the videos that people want. And if I make videos, no one watches them, then there's no point in doing it. So hit that like button and then hit the subscribe button and hit the bell next to that. If you have just seen me for the first time, hit the subscribe button, hit the bell, and then YouTube will send you an alert when the next video is up. And that could be a trade. So do that, and I'll be talking with you later.